This is the Daily Market Rundown live from the Tradelo trading floor. It's February the 28th. Some highlights from today's show. The Fed has just signaled an end to QT, Trump raises tariffs on China, and BTC enters the bear market. Good day, traders, and welcome to the final discussion for this month. It is the penultimate trading day of the month. We'll talk a little bit more about that, what that means in terms of trade opportunities a little bit later on. But let's get stuck straight into it. I think the key takeaway from yesterday's session is that sentiment is now very, very clearly negative. We can see that not just in the bonds, we can see it in the equities, we can even see it in the crypto space. So that is the framing as to which we come into the month in now. It's pretty negative across the board, and like we've been talking about over the course of this week and last, this sort of narrative switching away is not going to happen anytime soon. We're not going to suddenly rebound and suddenly have straight line reversals. Yes, we will of course get squeezes in some of the risk markets, but the reality is now sentiment is sour until further notice, until we of course get some form of very strong eco data, and that's not coming until the latter half perhaps of next week. Now let's turn our attention to our first topic for today, and that is of course all about the Fed signaling an end to QT, and it's something that wasn't actually picked up on. But before we get to that, just a brief discussion in terms of, as we come into month end, what does it look like across the board? Where is the weakness? This is very important as traders. We always need to be assured that we know where relative strength is and where relative weakness is. And if we look at just the equities, for example, we can see that Europe, as of the end of the month, is very, very strong. Okay, the DAX is up 13% this year. If we compare that to the United States, we can see quite a significant divergence. Now, these are not small variations. These are very significant, and it really points to this theme we've been talking about, and that's that re-acceleration idea going on in Europe, because we are seeing a number of governments talking about a lot of fiscal spending. Also, what's very important is if we are going to be trading the US equities, where is the weak index and where's the strong one? We can very clearly see Russell is the big underperformer in the US. Why? Well, because it's very closely linked to growth in the United States economy. And we can see the S&P right now is flat. Okay, and I think that's a key takeaway, because whilst market participants are panicking, whilst it feels like it's the end of the world, the reality is the S&P is completely flat for the year. Okay, so it's not like we're in any sort of panic stations yet. Sure, if we're down 5-10% over the course of the next month, that may call into question the Fed and perhaps ending of QT a lot sooner than expected. Now, that is our first topic of today, because it was not picked up on, and I cannot believe no one has actually mentioned this. I've not seen a single financial journalist come out and talk about what Fed Hammock told us yesterday. She told us in bright red that the Fed can manage liquidity issues with temporary operations. And we were talking about this yesterday, which is at some point one of these Fed members is going to signal that effectively QT is coming to an end. And there it is. Okay, now the reason I feel so strongly about this is a repeat of 2018. Now, many of you perhaps were not trading back then, but this is how it got communicated to the financial markets, which was they told us that, look, there are some sort of concerns about liquidity, and what they did in 2018 was they created these temporary bond repurchases, and they told us it's just going to be repos, so very short dated. In other words, they buy the bonds short dated and they run off almost instantly, so they're not there for very long periods of time, and they were telling us that it's just simply to manage some of the liquidity in the system in the near term. The reality is that was the end of quantitative tightening back in 2018, and the Fed was already cutting rates not too far after that. Okay. The point is what I want to stress is that was a very, very important signaling. You can go through that article and read through it, make sure you understand it. But ultimately, the thinking there from Fed Hammock is they want to just put a little bit more liquidity back into the system whilst the government is ultimately dealing with this debt extension. The point is, and if I just go and show it to you, back in 2018, there was a massive debate on Wall Street about was it actually QE or not. The reality is equities were selling off quite aggressively into the event. And when they did announce these temporary repurchase of repos, the reality is they ended quantitative tightening shortly thereafter. They started a QE not too far after that as well. So the point was, at base level, the balance sheet expanded, liquidity was pumped into the system, and equity markets absolutely loved it. Now, don't forget, Wall Street loves the idea of liquidity, and Wall Street is going to pick up on this at some point. Now, keep in mind, there's a sequence of things that need to happen. The Fed has not effectively begun these repurchase liquidity measures, but if they do, that is signaling the end of quantitative tightening. That will signal more rate cuts coming in the very near term, and it will also likely signal quantitative easing is coming perhaps later on this year. So keep an eye on it. What I'm not stressing is that is the base case. That is not the consensus view, but it's something you have to pay very close attention to. You are on notice now, okay? So that's what happened. You can go and read through that in your own time. Now, just to remind you of what that chart looked like back in December, it was round about that those temporary liquidity repos began, and you can see that's the daily equity market, that's the daily S&P. You can see not only did we reverse that, if you go to March, that is when they formally ended the quantitative tightening. If you go to effectively July that last year, if you go to the middle of that year, they began effectively cutting interest rates, okay? That was a very significant rally in the 2018-2019 period. So just go and have a look about that. Go and have a read up about that. The point is that the markets love liquidity. If they are going to get liquidity, if they are going to do this sort of QE, not QE debate where we're going to just pump liquidity into the market, don't be surprised if the equity stage a rally on that. Okay. At the end of the day, don't forget as well, liquidity does just simply squash volatility. And if volatility gets squashed, momentum comes back into the play. And that's why you get these sort of straight line type moves. Okay, let's turn our attention then. Of course, Trump is back in the news. He's thrown a couple of curveballs again. We've now sort of had a back and forward where, the previous day we were told that they're studying Mexico and Canada trade policy, and we'll probably only find out about something about it in April. Yesterday, Trump came back to say, look, Canada and Mexico is not doing enough on the border security situation, and so those tariffs are coming in play as soon as next week. Now, that's something we have to pay attention to. Again, is this just sort of strong rhetoric, or is he actually going to impose those tariffs? He has also told us he's going to put 10% on China. Okay, if this all comes into effect, I think you are going to see not just sentiment continue to sour, but in perhaps escalate. I think that is the key takeaway now. Should he go ahead with these March 4th tariffs, don't forget there's a lot of talk that both Canada and Mexico will be in a recession in short term. China will of course retaliate to it as well, so we will just be in an all-out global trade war, okay, and that is not going to be positive for equities. It is going to be some sort of a global correction in the equity markets, so keep an eye on that. Again, that's not the base case, that's not the consensus, it's definitely not what Wall Street thinks. Okay, Wall Street at the moment doesn't really show any concern with these tariffs. Why? Well, because every time they show concern, what does Trump do? We'll extend the deadline. Okay, so people keep getting caught out thinking that suddenly the playbook's going to change. The reality is Trump's playbook has always been threaten, get what you want. Does he actually go ahead with the threats this time? If he does, again, what you will see next week is a lot more mayhem in the market, a lot more volatility, a lot more bonds rallying, equities offering, etc., etc. Now, with that in mind, let's turn our attention, talk a little bit about the technicals, because like I said, S&P is flat on the year. It's not done a great deal so far. We have broken through a lot of those moving averages. You can see in the 20-day, we've snapped straight through it. The 50-day, we've snapped straight through it. And we're now starting to move towards that 200-day. I will show you a chart in a minute, but it looks for all intents and purposes that we are now going to test in that 200-day moving average, particularly given where the VIX is and the sentiment. Does it bounce there? Perhaps it does, perhaps it doesn't. The last time we had a retest of the 200-day moving average was actually at the low of this recent trend. That was back in October 23. So you can see we tested it and the market stage is a very significant rally. So this is nothing more than a correction. Should we get to that 200 moving average? It's around about 7% correction. Is that a healthy correction? Yes. Can it go more? Possibly. The point is we need to know where that 200 moving average is. If we get there pretty quickly, as in some point next week, don't be surprised to see the market stage a little bit of a bid off of that 57.15 level in the cash market. Now, I just want to compare this to the last sort of time we entered a bear market. If you go back to 2022, I just want to show you what the chart looks like because there's so much similarity, eerily similar between now, current day, and 2020. And what you can see is how the market very aggressively trended away, never tested that 200 moving average. It came down, it tested it, Okay, so you can see there we actually had a nice test, extended through it, bounced back to the 50-day moving average, really kind of stuck around for some time, but then we ultimately sold off. In other words, the bear market took a little bit of time to form, but ultimately that was the bear market of 2022. And as you can see, there's a lot of similarity between how we topped out. If I just go and clean this up and you look at ultimately what we did, okay, we had a little bit of a topping out pattern where the market didn't move, didn't do anything for a period of 3 months, extended, new record highs, came back inside, puked out to the 200-day moving average, bounced, and that was effectively the bear market. If we look at it current day, similar kind of thing. Market didn't move around, didn't do anything, extended to record highs, came straight back into the range, moving to the 200-day average. Am I calling for a bear market? No, I think the correction continues. We're probably going to trade that 200-day moving average, but we obviously need to remember that 2022 pattern, because if we do enter a bear market, guess what? You don't have to sell the high to make money in a bear market. You just need to know when the structure changes, when the market shifts, because then what you're looking for is these horrendous rallies into the 50-day moving average, and they will give you a lot of sell side opportunity. Okay, the key here is that bear markets is not something we want to forecast. We want to lean on the technicals and let the technicals tell us once we have now entered a form of a bear market. Okay, right now the patterns are eerily similar. I'm not calling for a bear market, but what I am saying is pay close attention because the charts look almost identical. Let's talk about Bitcoin, because that is a bear market. It has entered a 25% correction, and I do think we've got further downside. Let me talk a little bit about the technicals. I'll also just compare this to the last bear market we had in Bitcoin, and just to give you an idea of what to expect in terms of price action moving forward. Now, what I would have expected Bitcoin to do is something similar to what we did at the start of last year, which is I would have thought we would have had some sort of a pattern like this, where we had the initiative post the election, we formed that consolidation, and at some point I would have expected this to accelerate to the upside. That's the technical play that I think everyone was looking for. It didn't materialize. We've now come in below that 90,000, and we're just washing out and liquidating a whole bunch of longs. Okay, we tested that 200-day moving average earlier on today. Does that hold as support? Perhaps it does, but I don't think you want to be buying it there, simply because if we go back in a moment, I'll show you 2021. I expect we're probably going to come in and test this value area made pre-election. In other words, I think we're going to test the pre-election breakout. It's going to come somewhere between, I would say, 68,000 and 72,000, somewhere in there. I think you'll be allowed to buy Bitcoin. I think you'll be allowed to hold it for a few days. I think you'll perhaps get quite an aggressive, 10% bounce off of that. Do I think we go back up to record highs anytime soon? Absolutely not. Why do I say that? Well, look at what we did in the 2021 bear market. Okay, similar kind of formation. We rallied. We had a very aggressive funneling period at the top. Market looked like it was going to extend. And then all of a sudden, the bottom fell out. Everything got liquidated. And then we entered a very, very sort of narrow range, but for a 3-month period. Okay, so the market was just consolidating in a much lower range. Now again, in terms of those bounces, note when we did make that low, we bounced from 30,000 all the way up to 40,000. Okay, that is a good 30% rally. I know it doesn't feel like it or look like it on the chart, but it was a good 30% rally when we eventually found that bottom. Also note, it came right through the 200 moving average. It didn't even stop at the 200 moving average. And that's why I'm saying be careful buying this 200 moving average. I think you've got a little bit more downside, somewhere in around that 66,000 up to 72,000. That's where the Trump election breakout started. And that's why I think you just need to be a little bit patient with this. Let it come into this Trump election breakout somewhere in that zone over there. I think we'll get there in relatively short space of time. Don't be afraid then to play that bounce for that 10% type correction move. Okay. That is a wrap for today then, in terms of some of the ideas, some of the charts, some of the things to expect. In terms of course, today it is month end. What that means is technicals take a little bit of a back foot. I would very much urge you to watch the month end, particularly equity markets, given the sensitivity, given where the VIX is trading. Keep a close eye. Flows will dominate the session today. We will, of course, get some of those flattener flows coming into the bonds as well. For all intents and purposes, though, sentiment is negative. However, that being said, there is a bit of sort of a weekend risk going into the close. simply because right now Trump's playbook has been to threaten. We do know that President Xi Jinping has not actually met with Trump since his inauguration, and so don't be surprised to see something over the weekend where the Chinese agree to have a conversation with Trump so that they can diffuse the situation. In other words, it looks as though now there is the risk that we do see a continuation of Trump's playbook, which is threaten, get everyone to the table, get them talking, and then we sort of calm tensions. That is something I think you've got to pay attention for over the weekend. You don't want to be holding on to any aggressively negative trades over the weekend, just given there is that event risk for potential calming of tensions over the weekend. Okay, any questions, of course, always post them in the Discord channel. Otherwise, good luck out there. It's going to be volatile. Make sure you manage that risk. Go make some money.